If you've locked in a profit on gold or silver, there's a question you've probably thought about. Do I really have to report it to the IRS? Not should you, but do you actually have to? Because if you spend any time online, you'll hear all kinds of answers, such as silver eagles are exempt, just stay under certain amounts. No 1099 means no tax. Cash deals, no paper trail. And I'll be honest with you, a lot of smart, independent people believe some of those things. So in this video, I want to show you what the IRS actually says, what it does not say, and where reality and the tax code don't always line up. Because there's a big difference between what the law requires, what gets automatically reported, and what people think is a loophole. As a tax professional, my job isn't to tell clients what they can get away with, it's to explain the rules clearly, explain the risks honestly, and let adults make their own decisions. And if you own physical gold or silver, especially if you got real gains, this is one of those topics where bad information can end up costing you. Hi, my name is Noel Lorenzana. I'm a CPA, but I'm not your CPA. This video is for general education purposes only, not personalized tax advice. Always talk to your own tax professional about your specific situation. How the IRS actually classifies gold and silver. So let's start with how the IRS actually looks at gold and silver. The IRS doesn't see physical gold and silver the same way it views stocks, ETFs, or real estate. And that surprises a lot of people. For tax purposes, physical precious metals fall into a category called collectibles. Collectibles include things like art, antiques, stamps, certain coins, and yes, physical gold and silver. And that classification matters a lot because when an asset is treated as a collectible, it doesn't get the same tax treatment as other investments. With stocks or real estate, if you hold them longer than a year, most people pay a long-term capital gains rate of 0, 15, or 20%, depending on their income. With collectibles, the IRS allows a higher maximum tax rate, up to 28% on long-term gains. Let me be very clear here because this gets misstated all the time. That doesn't mean everyone automatically pays 28%. It means your gain is taxed at your capital gains rate, but capped at 28% since it's a collectible. If you're in a lower tax bracket, then you may pay less. The 28% rate on collectibles isn't automatic. You pay your normal long-term capital gains rate, but unlike stocks, the rate can go as high as 28% instead of capping out at 20%. Now, if you sell gold or silver that you've held 1 year or less, that's even simpler. That gain is taxed as ordinary income, just like wages from your job, no special tax treatment at all. So right out of the gate, before we even talk about reporting or enforcement, physical precious metals start at a disadvantage from a tax perspective. That's just how it's classified. And once you understand that, a lot of the confusion starts to become clear because most of the loophole talk doesn't change this classification at all. No specific coins, no bar size, no transaction amount. Changes the fact that under current law, gains on physical gold and silver are taxable. Which brings us to the next big source of confusion. If it is taxable, how does the IRS even know you sold it? That's where this Form 1099-B comes in. Proceeds from broker and barter exchange transactions. Form 1099-B and the big confusion. This is where most of the confusion starts. People hear about Form 1099-B and they make assumptions. If the IRS doesn't get a form, which means you didn't get one either, do you still have to report the sale? So let's clear that up. Form 1099-B is typically used to report stock sales. Form 1099-B is not just about your tax obligation. It's about a dealer's reporting obligation. That distinction matters more than anything else in this conversation. A 1099-B is filed by brokers, dealers, and certain intermediaries to tell the IRS, hey, this transaction happened, here's who sold and what they sold, and here are the gross proceeds amounts. When one gets filed, the IRS has third-party confirmation that a sale occurred. When one doesn't, there is no automatic reporting notice sent in to the IRS. And that's where people jump to the wrong conclusion. Not receiving a Form 1099-B does not mean the sale is tax-free or the gain is not reportable or that reporting is optional. It only means there was no third-party information return that was sent to the IRS. Our tax system is built on voluntary reporting. You are legally required to report taxable income whether or not you receive a tax form. Now, if you research online, this is where things can get confusing. You might see blog posts, charts, lists, very confident claims about exempt coins or safe sale amounts. So I went straight to the source. I pulled the actual IRS 1099-B instructions, the same document dealers are supposed to use. And what the IRS actually talks about there is not coins or bars or privacy. It talks about regulated futures contracts. In plain English, the IRS says, a precious metal sale is generally only reportable by a dealer if it involves a metal that trades on a regulated futures exchange in a quantity large enough to meet the minimum size of a futures contract. That's it. So if it doesn't meet those requirements, then no 1099-B. Also, keep in mind, there is no IRS guidance that I could find that says silver eagles are exempt or that constitutional 90% silver over $1,000 face value triggers reporting. I couldn't find that language on the IRS website. Go take a look yourself. What the IRS gives is a technical futures market test for dealers. And the IRS is very clear about one more thing. Sales within a short time window are aggregated. And if a dealer knows or has reason to know someone is trying to avoid reporting, the exception doesn't apply. That's straight from the instructions. So if you hear someone confidently rattling off exact coins, exact ounce amounts, or saying, just stay under this number, understand what you're really hearing. You're hearing some made-up industry generalizations. And again, even when no 1099-B is filed, the tax rule doesn't change. A taxable gain is still a taxable gain. Now, all of that is the law, but law and reality don't always feel the same. And that brings us to the part people don't like to say out loud. Whether you agree with it or not, the US tax system is built on voluntary compliance. The IRS doesn't monitor every transaction. It relies heavily on third-party reporting and self-reporting. That's just how the system works. And physical assets, by their very nature, don't generate the same automatic paper trail that paper assets do. Because of that, there are people who own gold and silver who probably won't ever report their sales activity. And honestly, I understand why people feel that way. Some people don't trust institutions. Some value privacy above everything else. Some see physical metal as money or financial insurance, not an investment in the traditional sense. And yes, there are people who believe that if something isn't automatically reported, it's unlikely to ever become an issue. By the way, if this type of information is helpful, hitting like and subscribe really helps out the channel. Thank you. And here's another important part. The IRS position doesn't change because enforcement may be lacking. The law doesn't say, report it only if we can see it. It says, if you have a taxable gain, you are required to report it. Whether someone chooses to do that or not, it's not a tax strategy. It's a personal decision that comes with a risk. And a risk cuts both ways. Most IRS audits don't start with physical gold or silver. They start somewhere else entirely. Maybe a bank inquiry, an unrelated audit, maybe a mismatch in lifestyle and reported income. And if and when that ever happens, the burden doesn't shift to the IRS. It stays with the taxpayer. Penalties and interest compounds. and the statute of limitations may not even start running in the event of fraud. Listen, I'm not here to lecture anyone. I'm just trying to draw a distinction between what the law requires, what gets automatically reported, and what some people choose to do anyway. Now, if your goal is to reduce taxes legally, there are planning tools built into the system, and that's where we're going next. Tax planning options that actually work. If your goal is to reduce taxes without playing games, this is the part that actually matters. I'm going to keep this high level. Number 1, holding period. This is basic, but it's amazing how often it gets ignored. If you sell physical gold or silver in under 1 year, the gain is taxed as ordinary income. Over 1 year, you're at long-term tax treatment subject to collectibles rules. That single timing decision can mean the difference between a reasonable tax bill and maybe a painful one. Number 2, location matters. Federal tax rules are only half the picture. State taxes can take a big bite. Some states tax capital gains as ordinary income, some don't tax income at all. Some tax bullion purchases, some don't. Just keep in mind that once a sale happens, the tax results are locked in. Number 3, retirement accounts. Under current law, certain retirement structures can dramatically change how gains are taxed. A Roth IRA is the clearest example. When properly structured, a Roth IRA can hold certain types of physical gold and silver. Basically, you contribute after-tax money. Growth inside the Roth IRA account is tax-free. Later on, qualified withdrawals are also tax-free. So even though physical gold and silver are normally treated as collectibles, that classification doesn't matter when the metal is held inside a properly compliant IRA. Just know there are rules, there are custodians, there are storage requirements, and there are costs. But from your pure tax perspective, this is one of the few ways to get around the capital gains tax issue with gold and silver. Number 4, record keeping. This is the unsexy part nobody wants to talk about. Cost basis matters, dates matter, documentation matters. If you don't know what you paid, when you bought, or how much you sold for, you're already in a weak position. Good records don't just reduce tax, they can reduce stress. If you ever need to explain a transaction, memory alone won't cut it. Let me be very clear about something. Planning is not assuming something isn't taxable just because no form was issued, or relying on everyone does it logic, or I read it on the internet, so it must be true, or even building decisions around what you think the IRS can or can't see. Laws, reality, and personal responsibility. Let me bring this all together. Physical gold and silver occupy a strange place in the tax world. The IRS treats them as collectibles. That means higher potential tax rates. And it means they don't get the same tax treatment as stocks or real estate. There's also a lot of confusion around reporting. Form 1099-B is about dealer reporting, not your tax obligation. No form does not mean no tax. And the IRS does not publish a list of exempt coins or safe amounts to avoid reporting the way the internet often claims it does. But correct me if I'm wrong. And at the same time, we all live in the real world. The tax system relies on voluntary compliance. Enforcement isn't perfect, and physical assets don't create the same automatic paper trail that other assets do. Some people will choose not to report their activity. They've already made that decision. And I'm not here to judge that, but it's important to understand that the legal obligation does not disappear just because detection is difficult. That's not tax planning, that's a personal risk tolerance. If your goal is to reduce taxes within the rules, there are legitimate planning considerations. Understand holding periods, being aware of state tax exposure, using retirement structures under current law, and keeping good records. There are also advanced strategies people talk about, like loaning out your precious metals instead of selling, but those come with their own risks, so I've intentionally left it out of this conversation. One planning concept that is worth also mentioning is step-up basis at death. Under current law, when assets like gold and silver are inherited, the cost basis is generally reset to the fair market value at the date of death, which can dramatically change the capital gains outcome for heirs. That's not a loophole. That's just how the tax system is written. As a professional, my job isn't to tell you what you can get away with. It's to explain what the IRS actually says, what it doesn't say, where the myths come from, and where the real risks are. What you do with that information is ultimately your decision. But if you own physical gold or silver, especially with real gains, you owe it to yourself to understand the rules. That's the difference between holding assets and managing wealth. But let me know what you think about reporting your gains on precious metals, or were they lost in an unfortunate boating accident? Let me know in the comments. And if you want to know why we just might be entering a panic phase in silver, then you need to check out my video right up here. Thanks for watching, and I'll see you in the next video.